Hello, beautiful people. Welcome to another brand new episode of the ITU Forex class. In this week's episode, we're actually going to be talking about hidden divergence, okay? Hidden divergence is the opposite of regular divergence, and for those who are regulars to the ITU Forex class, you'd know that we've talked about the regular divergence in a couple of classes back. Okay, so you're quite familiar with what the concept is, but for the benefit of those who are just joining us and those who are completely new to trading, who actually don't know what divergence is, let me quickly explain it to you in a way that you're going to hopefully understand it. Okay, so basically, what happens is, or before we reach that stage, technical indicators are grouped in categories. Okay, so in MetaTrader, when I click on the Insert tab here on the navigation menu and I hover my mouse's cursor over indicators, you notice that the technical indicators have been grouped under categories. We have a category for technical indicators which are considered trend indicators, trend technical indicators, okay? And then we have a category for oscillators, okay? Basically, oscillator, any technical indicator which is classed or grouped under the oscillator category of technical indicators, usually it usually resonates from a level of, a reading of two levels. Maybe for example, let's say from 0 to 100. So some indicators might, when they are at 0, it might be telling you that that particular instrument that you're analyzing is oversold, okay? And some of them, when it's at 100 or above, a certain level like 70, for example, it's telling you that that particular instrument you're analyzing is overbought, okay? So this is just an example, okay? Now we have technical indicators again, which are classed under the volumes category of technical indicators. We have some for the Bill Williams. These were technical indicators which were created by the renowned trader Bill Williams, okay? And then here we have a category for your custom indicators, okay? These are usually indicators that you install, or you have coded by some, freelancer or developer or anywhere you get them, but they are custom. They are not native to the MetaTrader platform. You got them somewhere and you want to use them inside MetaTrader, okay? So, moving on. When we talk about divergence, usually you'd notice that divergence tend to be paired with the oscillator category of technical indicators, okay? And the reasoning behind them is that when price is doing one thing, in a perfect world, the oscillator is also expected to do the same thing that price is doing. Okay, so when price is making higher highs and higher lows, the oscillator should also be making higher highs and higher lows. It should be in agreement or in alignment with what price is doing. But then what we call divergence is when price is doing one thing and the oscillator is doing the opposite thing that price is doing. So for example, you can see that price has been forming higher highs and higher lows, higher highs and higher lows, higher highs and higher lows, okay? But then when it reached this stage, it actually started struggling to continue making higher highs and higher lows. But then out of the blue, it made a high which barely broke above this high. Now, even though I don't have an oscillator on my chart, I'm pretty sure that it's very, very likely that the higher high that we have here, okay, that price has printed, the oscillator that we're going to be adding to the chart is likely not going to have a higher high, which would be a signal to tell us that price is likely going to reverse to the downside. Okay, now let's quickly add just a simple stochastic oscillator for this example. Okay, so let's click on insert. You can use the relative strength index. In fact, let's use the relative strength index, because with the stochastics there are two lines. You have to pay attention to the which one you're looking at and all of that. For the RSI is only one line, and it makes it very simple, okay, to analyze divergence and all of that. Okay, so we're going to be using the default period, which is the 14 period here, and the levels we're just going to leave it. In fact, if what you want to be trading is just divergence, you might not need to have those levels, because most of the times traders who use the levels of the stochastic oscillator, either the 30, the 70 or whatever, is to show them when price is overbought or oversold. And maybe if they use the 50 level, is to show them when the market is bullish or bearish, depending on whether price is above or below that 50 level. Okay, so it doesn't really matter, but I'm just going to leave it on the charts because it doesn't really matter all that much. Okay, so I'll click on OK. And guess what? Exactly what I told you. Because again, I'm going to explain the logic behind this. You'd understand why I anticipated this even without having the indicator on my chart. So remember what I told you. In an ideal world, what you want to see is when the RSI, when price is forming highs, okay, you want the RSI to also form highs, just like we had here. When price is now pulling back and then forming higher highs, you also want the RSI to form higher highs. But you see, we don't have the formation of a higher high here because price formed this high, which is obviously higher than this high, but then on the RSI, it's not. So we have a divergence, we have a disagreement. Now, this type of divergence is known as regular divergence. Usually, when regular divergence occurs on a chart, it is a reversal trading signal. For example, the market was in an uptrend. And then all of a sudden, when price formed a high which was higher than the previous high, the oscillator didn't agree with what price was saying, and so it didn't form a high which was higher than the previous high. So now we have a regular divergence. When you see a signal like this of regular divergence, it is showing, it is an indication that price is likely going to reverse and stop making that uptrend move, even if that's going to be temporarily, for example. Okay? So that is regular divergence. That's all what we're going to be talking about in this week's episode. What we are talking about is hidden divergence. That is the divergence that you're going to see when the market is trending to one direction and then you want to join the trend. Okay? So let's say you're a pullback trader. Remember, market structure of an uptrending market is when price forms a high and then it pulls back to form a higher low. And then it forms a higher high because this high is obviously higher than this previous high and this low is higher than this previous low. So it's forming higher highs and higher lows, okay? So price continues doing this. The hidden divergence is what we use to identify when this pullback is likely over. And so that's when we get into the market and jump in the trend in the direction of the predominant market's trend. Okay? So that's basically what hidden divergences are. Now, before we reach this stage, I told you I was going to let you in on something quite important, okay? You see, the way I saw that there was likely a divergence, a regular divergence on this chart, even without adding the oscillator, the relative strength index on the chart, was because of the momentum that this price action showed when it formed this high. So let me quickly explain what I mean, okay? So if you take a close look at this chart, you'd notice that from this move, from here all the way to here, you notice that we have 37 at the furthest left, and then in the middle we have 7,860, and then at the right, furthest right, we have 160.262. This is using the crosshair tool in the nav bar. You see this thing that's like a cross. When you click on it, this is known as the crosshair tool. It helps you to measure price movements inside MetaTrader, and it gives you a host of information along with that, okay? So that's what I used now, okay? So when I measured from down here, when I click on the chart and hold the mouse and drag it all the way up here, what this tool is now telling me is that it took it 38 candles for price to move from all the way down here to all the way up there, and that move is around 8,088 points, which is basically 800 pips, okay? About 800 pips, give or take. So this is how far that price moved, and this is how many candles it took it to make that move. Now, this is the daily time frame of this currency pair. So since it's showing us 38 days for this move to occur, this is basically a little over a month for price to make this move. Okay, now pay attention to what I'm going to show you next. Pay very close attention to what I'm going to show you next. You see, when you take the same crosshair tool and you measure from all the way down here to all the way up here, which is the high that we had around here, which is higher than this previous high, you notice that it took it around 10 candles, but it didn't move as fast as this previous movement occurred. So this is showing us that momentum has likely slowed in the market. So if before the bulls were just running with full sprint, they were energized, they were full of momentum and all of that, they were pushing the markets like nothing you've ever seen before. Now, with this move that we saw, it's like they're not as strong as they used to be, because it's taking them longer to move a lot to push prices a lot less than they did in the past. And so this is showing us that their strength in the market is beginning to decline. And that, in a nutshell, is all these indicators are trying to show us when we are trying to measure divergence. Okay? The indicator is trying to measure the strength of the move of a previous session of a previous time period and compare it to that of a previous of another separate time period and see which one is stronger. If the momentum keeps going and strong and strong and strong, then price is going to be in agreement with what the oscillator is doing. It's going to, if price is forming higher highs and higher lows, as long as the momentum is strong and continually getting stronger, price is going to continue forming higher highs and higher lows. But if price, for whatever reason, starts to slow down and the momentum which price is using to move and rip the market is starting to slow down, the oscillator is going to show that to us as divergence on the price chart. That's basically what divergence is telling you. Okay? So, basically, what we have is this tool is helping us to gauge the strength of a move. And that's why when I saw that this move, just ripped through the charts with just a couple of candles, and then this one was kind of like struggling to break above this resistance, okay, I knew that the momentum here was weakening, and compared to this momentum that we had here, this was very, very strong. And so I knew there was going to be divergence, and this was our signal to short this trade, because when you see regular divergence, that is an indication for you to take a counter trend trade. A counter trend trade in this case is going to be a short trade because the market was in an uptrend. But since we started seeing weakness in the market, signs of weakness in the market, that was our cue to know that the momentum by the bulls was starting to weaken. The opposite is true for hidden divergence. Okay, now let's go to the lower time frame charts so that we can look at hidden divergence at a very close angle. And obviously, we've used the daily time frame for lots of examples. Let's use something else, okay? So, let's use something like the 1 hour time frame, okay? Now, what I want you to pay close attention to on this chart is the market structure that we have. What is the market structure that we have on this chart? If you take a close look at the chart, you'd notice that price has been forming highs and lows. But then all of a sudden, price couldn't form a low. Price couldn't form a low which was lower than this low. After it did this low, that's what I mean, okay? After it formed this low, it couldn't form another one which was lower than this low. You can see it just ripped and kept going up. So this is basically the market structure of an uptrending market, because for an uptrending market, price usually forms higher highs, higher lows. Remember? Higher highs, higher lows. Higher highs and higher lows. Okay? This in an ideal uptrending market condition. Now, what you'd notice on this chart is this particular chart, price was forming higher highs and higher lows, higher highs and higher lows. But then all of a sudden, this was a spike, because if truly this was a strong uptrending market, price would have no business breaking below this low. But this was kind of like a spike and a fake out, okay? But the reason why this would have still not told us that, okay, the market has switched gears from being an uptrending market to a downtrending market is because this particular higher low, price could never close below it. It tried and it spiked, it got rejected. It tried again, spiked, got rejected. So this support level actually held. And then after that spike, okay, price now continued forming higher highs, higher lows. Again, it tested this, but it couldn't form a low that was higher than this, and it kept doing this thing. Okay, now when you look at the oscillator, in a hidden divergence scenario, what you want to see is if price forms a high and a higher high and a higher low and a higher high, you also want to see the same thing on the chart. Okay, but then what you have here is this low is low, okay, and on the oscillator you can see it's very low also. But then this low is higher than this previous low. But look at what we have on the chart. On the oscillator, this low is actually lower than the reading on this low. So when you connect these lines, you see it slanting to the downside. And when you connect these two on the price chart, you see it slanting to the upside. This is what is known as hidden divergence. And as a trader who is trading hidden divergence, when you see this, automatically you know that since we are in an uptrending market, and price has tried and to break below this level and it failed to do so, when you see the formation of a bullish engulfing candlestick like this, you know that yes, this bullish hidden bullish divergence is likely telling us that the pullback has come to an end, and you could have taken a trade here and went for whatever profit target you wanted to. If you were using the tight stop loss approach, obviously when price made this spike, you would have been stopped out, but then eventually it would have moved to your upside. Okay, but if you're using a wider approach, you would have still gotten profit from this trade. Now, I always do these things in this class because I want to be as transparent with you as possible. You see, in trading, you cannot win 100% of the trades you take, no matter what you do. The only way you can be able to do that is if you have a crystal ball which shows you what's going to happen in the future. And for whatever reason, if you have that, I don't think you even need money for any reason, because obviously you know what you're seeing. Okay? The thing is, in trading, you're going to have winning trades and you're going to have losing trades. In fact, to be 100% honest with you, the trading strategies that I used to trade, most of my trading career, my win rate is actually lower than 50%. So over a large sample size of trades, for example, like 100 or 200 trades or whatever, the trades that I end up winning are usually less than the trades that I end up losing. But I still manage to end up being very profitable. And the reason for this is because I understand risk management. I understand that as long as I keep my risk consistent, I don't get emotional after a losing trade or a couple of losing trades and then start revenge trading. So if I was risking, for example, 1% of my trading account's capital and I took like 5 trades and all of them were losses, and now, I just blew my lead and I just bet the farm. I want to make back the 5% I lost. And so I risked 10% just that. So price would just barely move in my favor and I would recover everything I lost. Only for price to hit that particular stop loss for that 10% I was risking. Before you know it, if you use this type of habits, you're going to blow your account, no matter how good your trading strategy is. In fact, you can have a strategy that has a win rate in the 90%, but if you're not using proper risk management, you'd find it extremely difficult to be profitable in trading. I say all this to say that when I show you examples of these type of trading strategies, I'm not showing them to you and sugarcoating it in the sense that whatever trade you take is going to be a winning trade. In fact, that's not how trading works. In fact, I want you to have the mindset of, I want to prove this guy wrong. I'm going to take whatever he's teaching me and I'm going to go out there and try it, but I'm going to do that with proper risk management. So if he taught me this particular method of trading, for example, I'm going to test it out on 100 trades, not just 2 or 3 or 5, no, 100 trades. And then my goal is, after those 100 trades, I want to see how many trades I won with proper risk management, obviously, because if you're not doing proper risk management, then whatever happens, you're not still, it's just worthless, okay? So keep your risk consistent. If you're risking 1%, make sure that through thick and thin, through winning and losing streaks, through whatever the case might be, your risk per trade is 1%, except if you're doing some advanced risk management techniques, which if you're not even profitable, you have no business doing that. Okay? And secondly, you also want to take every single trading setup that your trading strategy signals to you. The problem with some traders is that they have a good trading strategy. And just like every good trading strategy goes through both winning and losing streaks, there are times when they're going to get some losing trades in a row. And when that happens, usually when they go through like 4 or 5 or whatever the number of losing trades, insert losing trade number here, when they go through that losing streak, when they see a signal, they'll be like, okay, the last 5 trades I took were all losing trades. And so I'm very, very positive that this trade is also going to be a losing trade. And before you know it, they'll skip taking the trade, only for them to, in most situations, see that that trade would have ended up being a profitable trade, which would have likely made up for all of the losses that they took. Okay, so you have to stick to your trading strategy through thick and thin. Whether you had 5 or 6 or 10 losing trades in a row, when you see a setup set up by your trading strategy, you take that trade regardless. Again, whether the last 10 or whatever number of trades were winning trades, when you see the next trade setup, you don't get overconfident and greedy, because now you're feeling invisible since the last 10 trades you took, for example, were all winning trades. Now you feel like, you know more than the market, and so your trading strategies has cracked the market finally, and so you don't need to practice proper risk management. No. Keep your risk consistent, stay disciplined, and keep doing it. And when you do this, eventually, if you're trading with a positive risk to reward, it doesn't even matter whether you're trading with a positive or negative risk to reward ratio, because at the end of the day, as long as your wins, the profits from your winning trades are larger than the losses from your losing trades on average, you would end up being profitable, whether you're trading with a negative or positive risk to reward ratio trading strategy. Okay, so I did all of this explanation to make you understand that we teach you these methods, but we don't teach them to you and kind of sugarcoat it in the sense that, okay, when you use these methods, you're not going to get losing trades, because that would be a lie. Okay, but rather we want to let you know that losses are inevitable in trading, and you have to prepare for them if you want to be successful in this business. Okay, so this pretty much brings us to the end of this week's edition of the IT Forex class. But before we end up the class, I would want to quickly do a recap of what we talked about. Okay, divergence is when you have price and the oscillator, it could be any oscillator, relative strength index, stochastic oscillator, MACD, anything, any of the oscillators. Okay, so when you have price doing one thing and the oscillator doing a completely different thing, that is what is known as divergence. Okay, so this was the which currency pair are we looking at? USD/JPY. Let me open a separate currency pair so that you can, just to show you another example. Okay, where's my market watch window? Here. Let's look at something like the Euro USD, for example. Okay, great. This is a great example. Okay, yep. So you can see that price was in a downtrend. Why did I say price was in a downtrend? Because you can see that price was making lower lows. It was making higher highs and higher lows, higher highs. But then all of a sudden, it couldn't make a high that broke above this high, and so it made a lower high. Okay, so this uptrending move at this point, it has been nullified when this move started forming in the market. So we had a low, lower low, lower high. Low, lower high, lower low, and then by this point, this market structure has reversed from being the market structure of an uptrending market to that of a downtrending market. Now, when you look at the oscillator, you notice that this is what it did, which is what we want to see it do, because price formed the high here, and the oscillator also formed the high. Price formed the low, the oscillator also formed the low. Price formed a low, a high which is lower than the previous high. The oscillator did the same thing. Price formed a low which is lower than the previous low. The oscillator did the same thing. But then you notice that when price formed this low, which is very low compared to this previous high, okay, you can see that the oscillator almost formed equal highs here. So we obviously have divergence in the market. Okay, so here, when you would have seen this and saw the bearish engulfing candlestick we had here, you would have taken a trade here with a stop loss here, and depending on the risk to reward ratio of the trade you are going for, look at the profits that you would have made. Okay, so again, this is a winning trade example. Does this mean that every trade you take using this concept is going to be a winning trade? Obviously no. But you only need a couple of wins with proper risk management to make a whole lot of money using this concept. Okay, so I hope this is drilled down into your heads, crystal clear, that this is the method. It's not as if you're not going to have winning trades, but when you manage your risk properly, they wouldn't even matter. That's what I'm just saying. They wouldn't even matter at the end of the day. Okay, so once again, thank you for taking time out of your busy schedule to attend these classes. But before we wrap up, I would like to use this opportunity to invite you guys to test out our suite of robots or expert advisors, which are designed to help you trade on your behalf and get you earning while you're learning how to trade. Okay, so you can decide to test them out with a portion of your portfolio of trading, and then hopefully start earning while you're learning how to trade. If you're interested, please reach out to us on any of our social handles or drop a comment in the comment section, and we'll be more than happy to assist you, show you how to set everything up step by step using our risk recommendations and everything. So once again, thank you for taking time out of your busy schedule and attending this class. I look forward to seeing you guys in next week's edition. Have a wonderful rest of your week, and God bless you all. Cheers.